So if you look at the overall global ESDM market size, so ESDM is nothing but electronic system design and manufacturing. So your electronics manufacturing is a subset of the electronic system and design manufacturing. So if you can see that in calendar year 21, the whole global market was around $880 billion, and it have scaled all the way up to $1 trillion. And this industry is undergoing a significant shift from the traditional OEM-led production to integrated system-level partnerships. So companies operating within the ESDM uh, value chain are increasingly providing the end-to-end solutions across the product lifecycle, encompassing the design, prototyping, and the assembly and the testing and post-sales support. So you can, on the right side of the image, you can clearly see that the emerging ESDM segment, and which has the highest CAGR in terms of the next 3 to 4 year view, is the automotive sector, industrial, and the medical sector. And this is the reason why these sectors are currently taking a shift from the OEM-led production to contract manufacturing. On all your mobile phones, IT, and consumer electronic systems, it have already been outsourced to a certain scale. So this is the overview on how the sector have evolved starting from 1980 till now. So during 1970, the EMS industry took shape, and with Solectron, who is the American EMS giant, so they had initially entered the market around 1980, and during this phase, OEM production or in-house manufacturing was the key aspect of the whole manufacturing of electronic systems. And post that, due to the economic slowdown during 1980 and 1990, they slowly started to outsource to contract manufacturers. Thereby, they were more focusing on the product innovation, their sales and support, and other aspects of the business. And during 1990 to 2000, the advent of surface mount technology came in, wherein it's a modern method for building the electronics, wherein the components are soldered directly onto a PCB surface. And it provides more sustainability and flexibility for the components. And this is the period where EMS players can able to scale even the complex PCB requirements across the industries. And during 2000 to 2010, the rise of fabless semiconductor models and the consumer electronics was the key structural shift in terms of the manufacturing of electronics. So, and these EMS providers were able to provide those systems at a very faster design cycles, and they were able to cater across the product in terms of demand. And post 2010, the original design manufacturer, they slowly expanded their role from assembly to design, prototyping, and testing. Thereby, they could able to provide more value addition to the OEM apart from contract manufacturing. And after calendar year 2020, that is where the whole geopolitical situations have tilted, and then there is a lot of shifts going among the global electronics market, which we'll see in the upcoming slides on how the the traditional countries like China, who are more dominant in electronics manufacturing, and how companies are slowly de-risking themselves from giving to other countries like India or Vietnam in terms of contract manufacturing. And this is the Indian-based market size. So if you look at in FY16, the market was around 38,400 crores in terms of the overall size, and it have grown all the way around FY20 in FY25, it grown all the way around 3.6 lakh crore. And we will talk in the upcoming slides on what is the reason behind this drastic shift, including domestic demand, a favorable policy by Government of India, and rising of global outsourcing and de-risking from countries like China. And if you look at the whole Indian electronics market, which is inclusive of the contract manufacturing and OEM-led production, it is it is valued at around 10 lakh crore. So, and the whole electronics production itself is going to grow at a pace of 21% till FY28. And within that, your contract manufacturing and the domestic electronics productions, which is excluding of the imports, it is growing at 27 to 33% across the board. And till now, there is a vast majority of companies who do insourcing, which is the 75% is close to done by the contract, which is done by the OEM, and it is slowly shifting away from those OEMs to contract manufacturers. So within the market segmentation, in FY23, across the Indian EMS market, 62% of the market is only contributed by the mobile phones manufacturing, and 14% is contributed by consumer electronics and appliances market. And all the upcoming high growth potential sectors like automotive, industrial, your IT hardware, telecom, lighting, medical products. So these are going to be a significant demand driver for the next 3 to 5 years because of its under penetration compared to the overall market. And within the Indian EMS companies, only 18 to 20% of the Indian EMS companies are listed, or the size is contributed by the publicly listed companies. And majority of the companies like Foxconn or your Pegatron, which does the contract manufacturing for Apple and other companies, they're all private companies. So those companies, so you can't play this team through the public listed companies because they only cater to about 18 to 20% of the industry size. And this graph will clearly tell you that how the electronics production went from 2 lakh crore in FY15 to 11 lakh crore in FY25. This is a 6 times growth potential in production. And how our exports. So government is not only focusing on making those products in-house or manufacturing in India, and they're also catering to export demands, which have grown 8 times to 3.3 lakh crore in FY25. So the global electronics manufacturing market, EMS market, is significantly larger than markets such as China or India, and it is estimated to be around $1 trillion, and it's growing at a steady rate of 5 to 6%. So this data in this picture is a calendar 2022 year data. Until now, there has not been a significant shift such that China still constitutes a very large proportion of the electronics production market globally. And growing regions like India, Vietnam, they're all trying to get the incremental wallet share or business from China due to the geopolitical situations. And the Indian EMS companies are, as an industry as a whole, is expanding at a rapid pace of 30 to 35%. And this image, this graph can clearly throw you the potential of how we are growing in terms of exports and not only catering to the demand of our own nation. So in FY18, it was closely around 5 to 10% of our overall market is catered towards exports, and it have risen all the way to 20% in FY24. So we can think that for the last 5 to 6 years only, government have more started to incentivize on making the electronics productions in India. But if you see other countries, they've all started very early compared to India. And for example, in China, they made a policy in 2015 wherein they created a policy called Made in China 2025, where their main focus is on technological self-reliance and scale leadership and setting the global manufacturing standards in electronics. And same like US, which is respect to National Defense or Authorization Act of 2021. So they were prioritizing domestic electronics and defense-linked manufacturing through this policies. And for Europe, the Europe's Industry 4.2 and digital single market. So their strategies aim to strengthen advanced manufacturing and automation because they already have a good presence in manufacturing. So they were focusing on more on advanced manufacturing, automation, and cross-border integration of electronics production. And if you look at Vietnam, so they came with a policy called National Industrial Policy Development Policy until 2030, wherein they want to position themselves as a low-cost, export-oriented electronics hub compared to global supply chains. And same like Thailand, they initiated a policy called Thailand 4.2 strategy, wherein they focus on upgrading their low-cost assembly to higher value electronics manufacturing. Since countries like Vietnam and Thailand, they already have a reasonable portion of electronics manufacturing, they were all trying to move away from the low cost assembly to higher value electronics manufacturing. And same like Indonesia and Singapore, they are also focusing on moving their value chain up from the low cost manufacturing to high value electronics rather than just mass production. And there are various factors which is driving the growth in the EMS, Indian EMS market. And one of the significant driver which we'll be presenting in the upcoming slides is that policy intervention, starting from PLI scheme which is introduced during COVID time, and your electronics manufacturing of components and your specs. So they're all incentivizing a lot more, mostly on the capex side, and as well as incentive sides in terms of in compared to the turnover or a sales achieved through a company. And China plus one strategy as well played a big role in getting all those companies, global companies, to set up their manufacturing plants in India. And since we as a country as a whole, since we are able to pro- utilizing a lot of electronics components in across industries, so we had a policy of reducing our imports, and these all policies put together became a biggest driver for this sector for the last 5 6 years. And still there is a huge runway for this industry to grow at 20-25%. And we'll come to the reason on why the sector as a whole, it has a potential to grow further. So these are the top 5 6 policies given by government of India. So it was started in 2020, wherein they focused on large-scale electronics manufacturing of mobile phones and other electronics components. So they had an outlay of around 41,000 crores for a period of 5 years, and wherein they could able to give 4 to 6% of incremental sales as incentives to the companies. And next comes your IT hardware incentives in terms of under the PLI. So it gives this. So this scheme supports the laptop, tablets, on all-in-one PCs and servers with an incentive of 5% over 5 years to reduce the India's dependence on imported computing hardware. And then came white goods policy, which covers ACs and LED. And this PLA also provide 4 to 6% of sales linked incentives to encourage domestic manufacturing. And telecom and networking equipment. So for the last 2 3 years, telecom and networking equipment exports as well as imports has been a significant driver for the economy, both in terms of catering to our own manufacturers, starting like your routers or the modules, equipment, sub-assemblies required for 5G infrastructure. And government were able to provide 4 to 7% target incentives on transmission equipments, IoT devices, switches, and routers. And medical devices as well, in terms of medical imaging, implantable and electronic healthcare devices. And they were also providing a 5% of incremental sales as incentives to the companies. And then came electronics component manufacturing, which is a huge PLI scheme introduced by the government. The reason behind is that since we are slowly moving from an assembly-led manufacturing to a whole ecosystem-led manufacturing, we need the components to be manufactured in our own country, apart from importing and just assembling the whole product. So for that, government is have an outlay of sorry, 22,900 crores for a period of 6 years. So the key takeaway here is that together all these PLIs are designed to move India from an assembly-led manufacturing towards a full electronics value chain, benefiting the overall EMS industries over the longer period of time. So this is a industry split in FY24, wherein mobile phones and consumer electronics contributed roughly 55% of your industry, and other industrial-based usage, it contributes the rest of the market. So slowly we are moving away from the assembly-led manufacturing, and the reason why is that still we are dependent on a lot of components that we use for our electronic systems. And China and South Korea, they have a significant share of importing those components in terms of using in our own EMS companies. So close to 72% of components we are importing from these two regions. And within that, key active components like diodes and transistors, displays, and other integrated circuits, we are all importing. And in terms of passive components, we are importing capacitors, PCBs, resistors, relays. And in the upcoming slide, we will discuss on how government is incentivizing to manufacture the PCBs from assembly to from PCBA to PCB, which is assembling the PCB to manufacturing the PCB, and your semiconductor OSAT, which is your outsourced semiconductor assembly and testing. So on the left side of the graph, you can see that the PLI scheme were notified around FY21, and post that how the overall electronics production and the components imports have risen, and that is the reason why government is focusing. Though initially they were focusing on getting all those products or uh, creating as an assembly-led manufacturing. So post the PLA scheme, the components import were growing at a 32% CAGR. So the government realized that there is a need for the whole ecosystem to diversify from countries like China and Vietnam. And that is why a lot of Indian EMS companies are now entering into a JV with Chinese companies in order to get the technology, because component manufacturing, it requires a huge upfront capex and a higher gestation period and comparatively high technological R&D compared to your assembly. So without the JVs between other companies presented in Vietnam or in China, it is difficult for India to scale up the component manufacturing ecosystem. And government, as we are all seeing in the news, that they are all incentivizing the joint venture with Chinese ecosystems, provided that the majority of the shareholding of the company is still retained by the Indian firm, such that the control is taken care of the Indian company. And this slide we have already discussed, and starting from how mobile phone led assembly, slowly we have scaled from there to RAC or LED PLA system on to IT hardware component based ecosystem. And post the rise in significant imports, government have reduced the import duty for all the various components in order to improve the competitiveness of the sub-assembly parts like battery cover, GSM antenna, SIM socket, PCB, and charger or adapter of mobile phones. And slowly these products are as well going to get manufactured in India through the JVs, which we discussed earlier. So if you look at the India's domestic electronic consumption per capita, in FY18 it was close to around 4,000 rupees per capita, and it have risen all the way to 7,000 rupees per capita. And there is a significant driver in terms of consumption as well. And within the industrial products as well, or the daily utilities, so in two-wheeler, four-wheeler, or the daily utilities like fan or energy meters, the traditional uh, products has a lower electronic content value, and the current system, which is IoT based or smart products, it has a significant increase in the content per equipment, and that multiplier effect will also play in terms of boosting the overall EMS sector. So here you can see the Indian electronics industry, and according to JP Morgan and Keynes Technology, it is expected to grow at 22% from FY25 to FY30. And that is the reason why all the companies are expecting a significant growth driver for this industry. And one of the reason why still EMS companies are very bullish on their growth is that if you look at the global EMS market compared to the Indian EMS market, Indian EMS market is close to 4% of global market as of FY23. And this is the reason why still there is a lot of headroom in terms of diversification against countries like China or Vietnam due to geopolitical situations. And same it applies to global PCB market and global OSAT market. And you can see that in PCB market, India contributes only 0.3% of global market. And in OSAT, which is your outsourced semiconductor assembly and testing, it contributes 0.1% of the global market. And this denotes a significant uh, potential of all the Indian companies which cater to these segments to grow at a 5 to 10 year time period. So Honhai is a legal entity name of Foxconn, and you can see how they have scaled from $250 million to close to $30 billion in 2005, and currently they are doing a more than turnover of around 300 or $400 billion, and this uh, revenue growth cannot directly apply to Indian companies, but this is the theme where Indian companies are growing at this pace, and you can see. They have scaled all the way around to $200 billion from roughly no revenues or lesser revenues in calendar year 2000. And post the reach of a certain scale, and you can see the growth rates coming down for those companies. And still, we think India is in this region, and still it can able to compound at 25-30% of in terms of growth rate. And there is a key difference between global giants and Indian players. So global companies typically they operate on a thinner margins, on an EBITDA margin of 6 to 7%, and they mostly focus on high volume commoditized products. And Indian companies they also do the same thing, but they are slowly moving away from high mix, low volume to high mix, uh, like high margin, low volume equipments in which caters to industrial sectors. And this is also one more interesting fact that the company called Luxure. So they were scaling at a rapid pace from $150 million to $30 billion, and you can see how the growth rates have evolved over the period of time. And also there is a ongoing talk in the market that all these CMS companies are valued at a very high multiple, and you can see these companies when they were growing at a very significant pace, they were valued at close to 30 times of forward PE. And slowly, as the growth rate have slowed down, you can see from calendar year 21 to 24, the growth rate have slowed down from 60% to 20%. There is a significant de-rating in terms of stock valuations from 1 year forward of 40p to 10p. And this fear is being spread in the market, and that is why the recent correction as well, EMS companies corrected a lot despite they having a growth potential, because they were trading at a higher double digit or close to triple digit P. So in terms of categorization of companies based on the product, so companies cater to consumer based electronics, or they can cater to industrial based electronics. So companies like Dixon, who majorly contributing to mobile phones, they were slowly moving to other segments on the home appliances side. So same like industrial AMS. So let's say if one company is catering to an auto vertical, they are slowly moving from auto to railway electronics or aerospace related electronics in order to diversify their business. And the general product categorization is that your mobile phones consumer electronics has a high volume growth, but it has a low margin, whereas industrial EMS or industrial electronics used in telecom, medical devices, they have a high margin, but it has a low volume. And this two phenomenons widely differentiate between the companies in terms of their capital allocation. And that is the reason why companies like Dixon have a very high ROC and very low leverage compared to companies like Keynes or Sirma or Avalon. They have a significant amount of leverage and they have a low return metric as well. And one of the reason too is that they are on a some companies they are on a capex phase, so their realization will be coming in the next 3 years. So that is the major differentiation in terms of product, which is your high volume low margin mix versus high margin low volume mix. So this picture can clearly identify on how companies are catering to each verticals. For example, Dixon, they mostly cater to mobile phones, telecom, and IT hardware, whereas companies like Kaynes electronics and electronics related to automotive manufacturing. And if you look at the scale of how the companies is growing, Dixon Tech is the highest rare growing player in terms of their overall growth, despite having achieved a scale of 40,000 crores. This is due to the multiple reasons that they cater to mobile phones and they are partnering, starting with Xiaomi, Realme, and even with Samsung, they are making the tablets. So they are making a joint venture with other companies as well, and that's the reason why. They are growing at a higher pace despite achieving a significant scale. And Avalon Technologies is an outlier in the last 3 years due to the export related tariff-related uncertainties and execution challenges. Same for Avalon or signed DLM. Apart from that, every company is for the last 3 years they are growing at uh, 30 to 50% CAGR. So we will quickly disclose on just a broad level mix of revenue mix of each of companies as on FY25. So if you look at for Dixon Technologies, mobile phone and other electronics manufacturing contributes close to 85% of their revenue, whereas consumer electronics and home appliances they contribute a minor portion of their revenue, and they are slowly diversifying against mobile phones, and they are also doing the component sub-assemblies as described in the previous slides due to the policy push on getting the assemblies or the component assembly of the products, component manufacturing of the products. So for company like Amber, their revenue mix 73% is coming from consumer durables like AC and refrigeration and air conditioning, and other electronics and railway subsystem and defense contributes a rest of the 25% or 27% of revenue. And same for Keynes, it mostly caters to industrial, which is your high margin, low volume segment. And so, if you can see, they have a very negligible presence on the consumer electronics side, and mostly they cater to industrials and automotive side. And for Sirma as well, so Sirma is a diversified player wherein they contribute 36% to consumer electronics, and they have a significant share on the industrial and the other sectors. So thereby they are playing a high margin, low volume mix, as well as the vice versa, as we discussed earlier. So Avalon mostly it contribute to industrials, and they to their overall revenue, exports is a significant revenue, and that is the why the company is not performing the recent quarters due to the tariff related issues. And for Cyan DLM as well, it's mostly into industrial AMS, wherein defense is contributing 50%, aerospace is contributing 75%, 25%. So we'll come to the important aspect on how what are the return metrics which are generated by the company. And to summarize, I have just included only 6 companies, top 6 EMS companies in terms of the return ratios. So if you look at Sirma, so they are mostly into industrial electronics, automotive electronics, and smart meters and consumer electronics. So their their plans is to shift slowly from the low margin consumer EMS to high margin industrial EMS, and their key drivers of the revival in terms of exports, it will play out from FY27 onwards, and that is the reason why their asset turnover ratio is very less on compared to consumer EMS companies like Dixon, who have a very high fixed asset turn of 15. So these have a fixed asset turn of 3 times. So one of the reason why EMS companies as a whole is having a very high multiple, high valuation multiple in stock market is that it has a huge runway of revenue growth and earnings growth, and there is a significant increase from their current return metrics. For example, for Surma, currently in FY25, they are doing ROC of 12.6%. So it is expected, according to JP Morgan estimates, it is expected to rise to 18 to 21% of ROC. So market is always pricing on the expected earnings growth, and there is a significant re-rating opportunity because the company is moving from 13% ROE to 20% ROE, and that is the reason why market is pricing well ahead of their actual execution in FY27 or beyond. So if you look at Keynes Technology, as I've said, they are mostly into industrial, and that is the reason why they have a very high EBIT margin, but they have a very low asset turnover ratio, both in terms of working capital and fixed asset compared to uh, Dixon like consumer electronics based players. And same like for Amber Enterprises, so they mostly their core products is into ACs, consumer durables, and they're starting their PCB assemblies, PCBs and electronic components. So they are also having an EBIT margin of lesser EBIT margin, and their fixed asset turnover as well is comparatively lesser, within the range of 1.5 to 1.7. And if you can see all the companies like Cyan, DLM and Avalon, every company has a huge opportunity to return to improve the return metrics from FY25 to FY28. The reason behind is that due to operating leverage, due to economies of scale and efficiency, as well as the fixed asset turnover getting improved due to the higher growth potential. So this is a rough capex and how much of free cash flow are generating among the companies. So if you look at the Dixon, so they are capex as a percentage of revenue as of FY24 is 2.4%, and it is expected to come down as mostly their capex phase is done. But for companies like Keynes, they are increasing their capacities in terms of their new OSAT, which is the semiconductor assembly, as well as the PCB manufacturing. So that is the reason why for companies like Keynes Technology, their capex as a percentage of revenue is increased from 5 to 35 percentage, and it will drastically reduce in the next 2 years once the capex phase ends. And if you look at the free cash flow, most of the companies are not generating enough operating cash flow, and they're investing in the capacities as well, and that's the reason why most companies are not generating sufficient free cash flow. And this free cash flow generation is still a long way to go, since either they are in the capex phase or they need scale and efficiency to in order to increase their operating leverage and growth potential. And for companies like Dixon, since they achieve the scale, they are able to achieve the free cash flow, and they're for the next 3 years they're expected to achieve a good free cash flow of up to 24,000 crores. So if you look at the valuation of top four companies, starting from the first image of Sirma's forward multiple, so you can see that the median valuation is close to around 42 times. And the reason which I've already mentioned is due to the earnings potential and the improvement in their ROC from 16% to 24%. And that is the reason why these companies are trading at a very high multiple despite the growth potential, because there is a significant improvement in the return metric. And same for Dixon as well, wherein they trade at a median multiple of 65, close to 65, and it is trading at near 5-year average. And for company like Keynes, they are trading at zero point 0.5 at above 2-year average of it valuations in terms of their median multiple. It is closely at around 70 times 1-year forward multiple. And for Amber, it is trading at 1-year forward multiple of close to 55. So you can see that this all these valuations are very expensive compared to the broader market, and due to the growth potential and the significant improvement in the return metrics. And if you look at the absolute P, still it will look very high, and that is the reason why we look at forward multiple. And one approach like we believe that investors should take is looking at the PEG ratio, which is your price to earnings adjusted for their growth. And these companies are trading at 1.4 to 2.7 times of it PEG ratio. And there are a lot of risk and constraints in the sectors as a whole as well. So there is a significant customer concentration risk in the whole sector, because within, if let's say if they cater to an industrial uh, companies, there will not be a huge diversification in the starting of the operations, and that is the reason why customer concentration risk is still the biggest risk, because it affects, let's say, for companies like Cyient and Avalon, there is a customer concentration risk, and that is why they are not able to deliver to what they have they're expecting to do so. So, and since they are the IP is still retained by the OEM, so they have a very low margin, as you have seen, and they don't have any significant pricing pressure, and any company can enter into a segment, put up capacities, and can able to gain the share or business. And there is a significant import dependency as well, and that is the reason why government is focusing more on diversification from China in terms of the components assembly. And working capital and cash flow is significant constraint for the whole EMS industry, except for few companies. And if you look at companies like Amber, post their issuance in the public markets, they have done QIP 2 times in order to fund their growth capex. Since all of their money is locked in either working capital or in the capacities, they have raised QIPs to mutual funds on FIIs 2 times post their listing. And similarly, Keynes have done uh, 2 times of QIP post their listing, and Sirma as well. They have done a QIP post their listing. And since the sector is as a whole is significantly driven by policy intervention, there has been some talk that the PLI incentives for mobile phone manufacturing is getting down, or it's getting pulled back from the government, and still government is in talks to finalize these issues, and companies like Dixon are under a huge uh, beneficiary of this PLI scheme. So, since they have achieved a scale, they don't need any more of PLI incentives in order to fund their company. So they are at a significantly better position compared to other players. And since this PLI support will be a significant driver for the sector as a whole, at least in the newer emerging areas or emerging opportunities like PCB market or semiconductor outsourcing, which we'll see in the upcoming slides. And for the import dependency as well, since government is currently not giving any permission or an authoritative permission, so EMS companies are asking the government to have a joint venture with Chinese companies, provided that they have at least 26 percentage of the Chinese companies have at least 26 percentage of stake in the Indian EMS companies, so that the technology transfer can be happening smoothly. And expected by the government, component sub-assembly and assembly as well, it will increase through the JVs. So if you look at the overall OSAT market size and opportunity, so in FY23, the market size was very negligible, and currently the market size is close to $40 million in the next 3 years. So it will be growing from $40 million to all the way to $200 million due to the large need of semiconductor assembly and testing in the Indian context, Indian electronics manufacturing context. And the PCB manufacturing as well, you could see that for the last from FY17 to FY21, there has not been a significant growth, but post COVID, due to the increase in the electronics, as a whole, the PCB market is as well growing at a significant pace compared to other opportunities. So the Indian printed circuit board PCB industry size, it's close to 40,000 crores in 2024, and it's expected to grow at 12% CAGR. And if you look at why government is focusing more on reducing the reliance of PCB, is that PCB is, as we have discussed earlier, it is a widely used component across the electronics manufacturing, let it be consumer or industrial based electronics. And you can see still a large proportion of this demand is serviced by imports, and government is trying to substitute by reducing the imports and developing on in-house manufacturing. And within PCB industry, there is 60% of PCB is occupied by the multi-layered PCB, and only 25% is occupied by HTA PCB. So these are different classification among the PCB, wherein multi-layered PCB have a very sophisticated use case or a very niche use case compared to other PCBs. So these are few examples on which companies are importing a lot of PCB and what end user industry it caters to. For example, companies like Bosch, which is into automotive, Samsung, which is into consumer electronics, so Nokia into telecom, and Tejas Networks, which is into telecom networking. So they are all a major import of PCB. So as we have discussed earlier, same like government providing incentives to mobile phone during the mobile phone manufacturing, government is also providing subsidies in terms of funding their capex. So if you can see, just for an example, I have took two companies. One is Amber and other one is Sirma. So Amber is doing a HTI PCB project, and out of the overall 3,200 project cost, 65 to 70% is given by government on a blended basis, and rest of the 30 to 35% is the net capex incurred by the company. And you can see that there is also a turnover link incentive from central government over a period of 6 year time. And these are detailed breakup on how this capex intensive from state government and central government is played out on your machinery components as well as land and other electricity related costs. So same for like Sirma. So out of their overall $91 million overall project cost, 40 to 50% of their overall cost is expected to be coming as a subsidy from the state government, and the rest of the project financing is to be decided in the due course of time. And the initial expenditure for the first 2 years is to be funded by the company. Maybe so that's the reason why they have raised the QIP as well. So the 33% of their overall cost is getting funded by the own company. So same like Keynes, whether they are putting a capex on outsourced semiconductor assembly. So out of their overall cost of 3,400 crores, central government under the India Semiconductor Mission is a very so we'll talk on about this mission and how what are the companies which are putting up the capex or facilities in capturing this mission. So out of this overall 3,400 crores cost, 50% of plant and machinery cost is taken care of by the government in terms of capex subsidy. And another 20 to 25% of plant and machinery cost is a subsidy given by the state government, and rest of the capex which is incurred by the company as a whole. And this example wherein how what kind of companies are putting up the capex on the India Semiconductor Mission. For example, Keynes Semiconductor, we have already discussed on this. Same like Tata Electronics, so they are putting up a semiconductor fab facility in Gujarat. So these mostly these semiconductor related capex is done through a joint venture. For example, HCL is doing with Foxconn, and so these without this joint venture, companies cannot build their semiconductor facilities on their own. And you can see the upcoming investments on the which is related to the India Semiconductor Mission as a whole. So we have come to the end of our session.